Well, there's been a lot of talk lately about France quietly pulling the rest of its gold out of New York and whether that means something much bigger is shifting underneath the global financial system. So, in this video, we're going to separate the simple headline from the deeper message, and you are going to walk away feeling a lot smarter and a lot more confident about what gold may actually be signaling right now. Today in New York, it is Thursday, April 16th. Let me know in the comments what day and date you're watching from. And if you value this kind of work, subscribe and comment John A.G. Best so I know you want more of these breakdowns. So in case you haven't heard the chatter going around, the basic version sounds like this. France moved the last chunk of its gold that had still been sitting in New York-linked custody, brought that value back into Paris, and did it quietly enough that most people barely noticed. On the surface, that sounds like a routine vault management story. Old bars, new bars, market standards, bookkeeping, end of story. But once you back up and look at the timing, the direction of central bank buying, the behavior of the bond market, the pressure building in private credit, and even the sudden panic around AI-driven cyber risk, it stops looking like a footnote and starts looking like a message. Now, to be fair right up front, I do not think every gold movement is some dramatic declaration of war against the dollar. Sometimes a technical move really is technical. France itself framed this operation as a practical reserve upgrade, and the mechanics support that explanation at least in part. A portion of older format bars was sold, replaced with standard bars, and the country's total reserve pile stayed basically the same size. So no, this was not some Hollywood convoy hauling every last ingot across the Atlantic under cover of darkness. But here's the part people miss. Even when the quantity stays the same, the jurisdiction matters. The custody matters. The ability to touch your own reserve asset without asking permission matters. And that is where the story gets interesting. Because this is not happening in a vacuum. Based on recently published numbers, China extended its gold buying streak again, making it well over a year of steady additions. Brazil sharply lifted gold's share inside its reserve mix last year, enough to make it a much more important part of the country's external cushion. And survey work from central banks themselves shows the same broad direction. More of them expect gold to rise as a share of reserves over the next several years, while fewer expect the dollar to hold the same dominance it used to enjoy. That does not mean the dollar disappears tomorrow. It does mean the world is quietly asking whether too much of its safety has been outsourced to promises issued by someone else. And that matters because gold is no one else's liability. It doesn't need a central bank to print it. It doesn't need a government to honor it. It doesn't need a digital network to verify that it exists. In an era when countries have watched reserves frozen, sanctions expanded, payment rails politicized, and alliances get a whole lot more conditional, that lack of dependency starts to look less like an old relic and more like strategic insurance. That is also why the biggest signal here may not be the daily gold price at all. If you're only watching the screen quote, you can miss the real behavior entirely. The price can wobble while the long game strengthens underneath it. In fact, one of the more important fresh developments over the last year is that gold has become more central in reserve math than many people realize. The European Central Bank said gold rose to about 1/5 of global foreign reserves at market prices in the prior year, overtaking the euro and sitting behind only the dollar. That is not a tiny symbolic change. That is a structural one. It tells you two things at once. First, the price move has been powerful enough to change the composition of reserves. Second, central banks have been accumulating metal at a pace we have not seen in generations. So when people say gold is a fringe story, I just don't think they're looking at the right layer of the market. Now, does France alone prove that trust in the United States has collapsed? No, that would be too cute, too clean, too easy. But it absolutely fits a broader mood. In Europe, concerns about depending too heavily on Washington have grown louder, not quieter. Even in Germany, there have been renewed calls to reconsider whether so much national gold should remain in New York. And when security reports start describing the world as more fragmented, more transactional, and more multipolar, reserve managers hear that language differently than retail investors do. They hear, what needs to be under our direct control if the weather gets worse? Gold answers that question in a way bonds, swaps, and digital claims simply do not. And then we get to the part that really scrambles the old playbook. During the recent conflict shock, gold did not behave the way a lot of people expected. It got hit hard. Treasury yields rose instead of falling the way classic panic textbooks would suggest. The dollar caught flows, oil ripped higher, and a lot of commentators immediately jumped to, see, gold failed, safe haven story over. I think that conclusion is lazy. Not crazy, but lazy, because what actually happened was more complicated. Gold got caught between fear and liquidity. Investors needed cash. Rising yields hurt non-yielding assets. Inflation fears pushed out rate cut hopes, and some speculative money that had piled in earlier got flushed right back out. That is not the same thing as gold becoming irrelevant. That is a market under stress selling what it can, not necessarily what it hates. That distinction matters a lot. There is a difference between a weak thesis and a crowded trade getting punched in the face. We've seen this movie before. In the opening phase of stress, people reach for liquidity first. Only later do they start asking which assets they actually trust when the policy response arrives. And that second step is where gold tends to re-enter the conversation. Even over the last few days, as markets tried to price the next phase of the Middle East picture, gold bounced while uncertainty around rates, inflation, and energy stayed alive. So the idea that one drawdown permanently disqualifies gold as monetary insurance just doesn't hold up for me. If you're successful, share your success story in the comments so others can stay motivated. Now layer on energy. Oil staying elevated does not just hurt drivers at the pump. It bleeds into freight, fertilizer, plastics, packaging, food, margins, and eventually payroll decisions. That creates a nasty mix. Growth cools, prices stay sticky, and central banks lose flexibility. That is why a war-driven commodity move can become a reserve story. Countries and institutions start preparing for a world where inflation is not fully dead, bonds are not the automatic refuge they once were, and policy mistakes become more expensive. One of the biggest strategic calls on Wall Street lately has been that commodities may be among the biggest winners for the rest of this decade. Another fresh report described the current setup as the beginning of a new commodity supercycle, powered by geopolitics, energy insecurity, and the physical needs of the AI build-out. You don't have to agree with every inch of that thesis to understand the direction of travel. And yes, I know what some people will say. If this is so obvious, why aren't all the giant institutions screaming it from every rooftop? Well, a few of them kind of are, just in a more polite language. Big asset managers have been telling clients to rethink concentration, stress test crowded positions, and diversify beyond the old assumptions. Others are openly arguing that commodities, not bonds, may be the more useful hedge in a world shaped by fiscal excess, geopolitical strain, and a weaker policy anchor. That is not the same as saying, sell everything and buy gold bars. It is saying the old mental furniture is being rearranged. And when that starts happening at the top of the food chain, retail audiences usually hear it late. But the gold story is not only about geopolitics and inflation, there is also the plumbing. Private credit has become huge, and more importantly, hard to fully see from the outside. Recent reporting shows large lenders disclosing tens of billions in exposure, while regulators and investors have become more focused on valuation risk, liquidity mismatches, rising defaults, and redemption pressure. Now, to keep this balanced, several heavyweights have argued the sector is not systemically dangerous, in the same way subprime mortgage leverage was. That is a fair counterpoint, and I think it deserves respect. Still, even if private credit does not become the next global heart attack, it can absolutely become another source of strain at a time when the system already looks overextended. And in an environment like that, reserve assets with no counterparty risk become more attractive, not less. Then there's the cyber angle, and this one really should make people sit up straighter. According to fresh reporting, US and European officials have been warning banks about the risks posed by a new anthropic model known as Mythos. The concern is not science fiction. It is that powerful AI systems may be able to identify weaknesses in legacy financial infrastructure faster than many institutions can patch them. Treasury and Federal Reserve officials reportedly spoke directly with major bank chiefs, while European supervisors have also been preparing questions for lenders. That is a huge tell. When the people running the modern financial grid start worrying about the resilience of that grid, the appeal of assets that can sit outside the grid goes up. Not because everyone is about to barter with coins at the grocery store, that's silly, but because analog diversification stops sounding paranoid and starts sounding prudent, and that brings us right back to France. Maybe the official explanation is true on paper. Fine, I can grant that. Old bars were less useful, new bars were more useful, Paris was the better final destination, but why does that practical logic resonate so strongly right now? Because sovereignty has been repriced, control has been repriced, optionality has been repriced. A reserve asset that you can hold domestically, outside someone else's political weather, carries a premium in a fragmented world. France may have described the move as technical, but the world is reading it as strategic because the backdrop makes that interpretation unavoidable. Here's the bigger picture as I see it. We are living through a period where the comforting hierarchy is being challenged all at once. Bonds do not feel as bulletproof. The dollar still dominates, but it no longer feels unquestioned. Energy routes can become geopolitical weapons overnight. Private credit is big enough to matter. Advanced AI is turning cyber risk from a background issue into a front-page one. And central banks keep buying the one reserve asset that does not need a trusted intermediary. You can call that coincidence if you want. I call it a pattern. And one more thing here, because I think this is where people can get a little too dramatic. A move toward gold does not automatically mean an overnight reset or some clean handoff from one world order to another. Systems like this usually fray before they fail. They get noisier, more expensive, less trusted at the edges. That's why I keep watching the Treasury market as much as the metals market. Gold can rise because people want safety, sure, but it can also rise because the alternative is losing some of its shine. When long-term borrowing costs stay stubborn, deficits stay huge, and official reserve managers start diversifying even a little, that changes the conversation. And remember, central bank buying has been running at more than 1,000 tons a year for several years now, with overall official holdings near levels last seen around the Bretton Woods era. That is not panic buying. That is slow institutional repositioning, the kind that looks boring in real time and obvious in hindsight. So what happens next? I think more countries quietly review where their reserves sit, who controls access, and what can be frozen, delayed, diluted, or politically leveraged in a real crisis. I think central banks keep favoring gold at the margin, even if they never say it loudly. I think institutions keep broadening the definition of diversification. And I think the next real test may not come from the gold market first. It may come from the bond market, where trust, deficits, inflation pressure, and policy credibility all collide. If that pressure keeps building, gold does not need a dramatic apocalypse to matter. It just needs the old confidence to keep thinning out. So let me ask you this. Do you think France was just cleaning up old inventory, or do you think it was quietly voting on the future of the system? And second, if trust really is the thing being repriced, which breaks first? Confidence in government bonds, confidence in digital finance, or confidence in the idea that the old reserve order still works the way it used to? Either way, I wouldn't spend too much time staring only at daily price candles and thinking that tells the whole story. The louder message is in custody, in reserve behavior, in delivery preferences, in institutional language, and in the fact that the smartest players on Earth keep building backup plans. When people with that much information keep reaching for optionality, I pay attention. That is why quiet moves matter more than loud headlines, and that's the frame I want you to hold on to. Gold is not interesting because it goes up every day. It's interesting because when trust gets thinner, leverage gets shakier, and the digital world gets more fragile, physical neutrality becomes more valuable. That does not guarantee one straight-line move higher. Markets never work that cleanly. But it does help explain why countries keep buying, why some want metal closer to home, and why this story is probably much bigger than one vault, one country, or one headline. As always, this is here to help you think more clearly and ask better questions. It's for education and discussion, not a personal financial blueprint. So take the ideas, do your own homework, and make decisions that fit your own life.